So what I want to do now then is look at 16.5. Now this is what we class as an exam level question for principles of tax. One of your questions, one of your compulsory questions is normally something like this. So you've usually got a compulsory question on income tax, similar to what we did in, I suppose, like chapter 2 of the first booklet. And then the other compulsory question is normally something like this for a company. Now, they are big questions, so what you need to do before you start reading through it is go straight to the bottom and find out what it is the examiner wants you to do. So we've got to calculate the tax adjusted profit for the year ended March 2020. So that means the profit after capital allowances. Then they want you to take that profit and work out the tax, and they want you to say when the tax has got to be paid. And then we just got a little bit of theory at the end saying when does a period start and when does a period end. So that's all about this 12-month rule that we've been talking about. So the big chunk of the question, we haven't got any marks here, but the big chunk of the marks would be for A, doing the tax adjustment. So you've done this many times before for an individual. It isn't really any different, apart from there's probably a little bit more to read. So the first thing I would suggest that you do is that you find out the year end, and hopefully it's a nice 12 months like it is here, not a long period. So that makes life easier. And you're going to take your profit before tax and you're going to adjust for your disallowable items. So let's set up the pro forma. So part A, tax adjusted profit. So I'm going to start with the profit before tax. And that is this 635,080. So we're going to begin by looking for our disallowable expenses. So anything that we spot that we think is disallowable. Okay, so let's start at the top. Now anything that's in the gross profit will be fine. Gross profit is often referred to as trading profit, so it's simply your sales and your cost of sales. So it's always anything below gross profit that causes any issues. So we're going to go down the list, we're going to read the notes as we go along, and we're going to decide what it is that we need to do. So the first item we've got here is the impaired debts, and that relates to note number 1. So let's go down to note number 1. Note number 1, we've got some trade debts written off, a customer loan, and the increase in the allowance for the trade debtors. So trade debts written off, well, they're fine because it's to do with our trade, but loans to customers, unless you're a loan company, that needs to be disallowed. Now we've also got an allowance for trade debtors, but it doesn't actually tell us what sort of allowance it is. So we're going to make the assumption that it's specific, i.e. I'm making an allowance for Mr. X or Mr. Y. I know exactly who it is I'm providing for, and I can provide evidence of why I think that customer won't pay. So I'm going to allow that increase. If it did say it was a general allowance, then you would disallow it. I don't think it'd be left open for you to make the decision in the exam, but if it were something like this question, then just state your assumptions. And as long as you treat your assumption correctly, you're going to get your marks. Now, remember what we did when we did this with individuals. You must show for each item how you're actually going to treat it. So we've got to show everything in our list that we itemise. So trade, debts, I don't need to write the full description, but I'm going to put a dash because it means I'm not adjusting for it. Whereas the loan written off for my customer, I'm going to add back. And why is it added back? Because it's an expense that made that profit smaller that the taxman is saying, no, you can't claim for it. So I need to add it back. Then we've got the increase in the general allowance, which I'm assuming is specific, and therefore I will allow it. Right, so remember there would be marks for itemising each thing. So if you just put the things in that you're disallowing and ignore everything else, you're going to lose some really easy marks there. So back to the pro forma then. We've now got depreciation. No note, but we know that depreciation is disallowed. So that should be the one that you all get regardless, because it's a standard one that we see over and over again. Add back your 83,320. Carrying on down, gifts and donations. These relate to note number 2. So let's go down to the second note. Second note we've got here. So donations to a national charity, disallow. Local charity is fine. I mean, it actually says they get some free advertising, but if they see the word local, accept it. Gifts to customers, well, they're only allowable, aren't they, if they're less than £50 each and they advertise for the company and they're not food, alcohol or tobacco. So because it's got the word food in there, then we need to disallow it. I know it's less than 50 quid, but it's got to have all of those in order to allow it. So let's go back up here. National charity. I don't feel like you've got to write it out word for word, you know, as long as it's something we can recognise. I wouldn't advise you to just sort of throw the numbers in there. I'd like some sort of description, but you don't have to write the full description. So next item, we've got some professional fees. Professional fees, 14,900, relating to note number 3. Oops, jumping all over the place. There we go. Okay, remember the rule then, if it's anything to do with the trade, it's allowable. If it's not trade, i.e. something to do with capital or raising finance, then you're going to disallow it. So the accountancy fee is fine. We've got the renewal of a lease. Renewal is okay. New lease, you would disallow because that's classed as capital. All right, renewal is like repair, allow. Now, there are some legal fees connected with issuing some loan notes, and it's got next to that note 8. So what we need to find out is what was the loan for. So let's go down to note 8, where it tells us that IPM raised some loan notes. The loan was used for trading purposes. So that's what we need to know. Regarding the legal fees, is it a loan to do with a trade purpose? So if it's legal fees to do with the trade, then remember it's allowed. So we don't need to disallow anything there that's in note 3. So accountancy fee, renewal of the lease. So new lease disallow because it's classed as capital. Renewal is like a repair, allow. And then the loan, I'm going to put in brackets, was trade. Therefore, any legal fees to do with that were okay. Number 4 then, repairs and renewals. So the figure includes 6,200 for replacing part of a wall. Remember, replace, renew, repair, allow. And then it says we've got some initial repairs to an office that was acquired during the year. So that would be disallowed. So if you buy an asset and you need to spend money to get it sort of into working order, when you buy it, the price you pay would have taken that into account. So we can allow the replacement of the wall. What we can't allow is those initial repairs. They're classed as capital. Now, I know in that note, it doesn't actually give you the breakdown of all of those things that you've got on your profit and loss statement. You know, it is just telling you that the figure on the P&L includes these. We've got to assume everything else is trade, because if it doesn't pull out the, you know, what they might relate to, then, you know, we can't carry on and assume they're disallowed. There is a little note underneath here about those initial repairs. It says the building was not usable until we carried out those repairs, and it was reflected in the reduced price. So that's sort of emphasising the fact that I made that, you know, those initial repairs clearly were capital costs. We bought the asset at knockdown price because we'd got to spend some money before we could use it. So if we go back up to the profit and loss statement, we've now dealt with all of those notes. It tells us that all the other expenses are okay. Now we've got the income. So those are the expenses. These are the income items. Look, 60,800, it's been added to the profit. So this is now looking at income. So I'm going to add a line here to my summary. I'm going to put deduct disallowable income. We have disallowable expenses and disallowable income. And the general rule for income is that you disallow it if it's not trade income, if it's not the main source of income that your business was set up to do. And the general rule is, without reading any of the notes, is that 99% of the time, anything that comes below gross profit is normally non-trade. But what I would advise you to do is still read the notes just to make sure that these three items are non-trade. So if we go down to note number 5, first of all, bank interest received, oops, got a bit crazy there. Bank interest received was for non-trade purposes, therefore disallow. Loan interest received was for a non-trade loan. I don't care how it's broken down, all right? Remember, we don't care about what we did to get it into the P&L. We're saying, what did we put in the P&L? And that's what we're trying to disallow. Because if it's gone in the P&L, it's affected your profit. And if you don't want it there, it's the profit and loss amount that you're disallowing. So at this point, you can actually forget about, you know, looking at how it's broken down. Don't let that confuse you. And then the other item you've got there is the dividends, and it says they're from other UK companies. Remember, dividends from UK companies are exempt, so we don't want to have those in there because we don't want to pay tax on them. So it is in this question, as it normally is, that all of the other income items need to be deducted. So we're just copying down what's on the P&L. So we've got bank interest, 2,800. We've got the loan interest, which is 22,000, and we've got the dividend. So we've now analysed everything that's in that profit and loss statement. We've gone through each of those items. So starting at the top, we've got the profit in the accounts. We've disallowed the loan written off to customers because it was non-trade, depreciation specifically disallowed, national charity specifically disallowed, as is the gifts because it was food. And then we've got the initial repairs to get the asset into a usable state. And then we've got 3 types of income being disallowed because they relate to non-trading activities. So at this point, my profit is 673,200. And all I really need to do to finish off this part of the question is to deduct any capital allowances. Now, they might be a bit more complicated than this question in the main exam. Here they're quite straightforward, so we don't really need a working paper. The detail about the capital allowances is found in the next note, plant and machinery. So it says the written down value of the main pool was 73333, and there were no purchases sales. So it couldn't be any easier, could it? That's your bought for balance to work out your capital allowances. I didn't buy anything, I didn't sell anything, so I'm just going to calculate it based on the normal 18% that I've got in that pool. So 7333 at 18%. You can draw up your pool if you want, put your bought forward in and write it down, but that can be kept simple really in this one, because you don't really need all that calculation, do you, if there's just one thing to do. So the final bit, as your tax adjusted trade profit, so the profit that you're going to put into your corporation tax computation is 60,133. So that answers part A of your question, and I will do a recording for part B in a separate section.